What the hell?
Good afternoon, Tim Murphy. Happy Halloween.
Dude, what's that Halloween shit, man? That's just another day in the world today. You know that.
Well, the
Halloween.
grind
That's
don't
when the
stop,
ghosts and
Tim.
goblins come out, man. I
The
don't deal with
grind
those people.
don't stop.
There you go. And that is the truth. And Brian, I'll tell you what, I've not been busier than ever, man. It is pumping. But what's pumping is 100% financing. People are just jamming on that shit right now, man. It is insane.
So, Tim, the
Yeah.
Fed dropped the interest rates, yet interest rates, what happened?
What direction? They went up, man. And people don't understand. So I think we should take just half a second here to talk about first of all, what is the Fed cut, Brian? You see people already calling you saying, hey.
Yeah, I know. They're like, hey.
Brian, tell me the story. They're cutting the overnight rate between the bank and the Federal Reserve. It has nothing to do with mortgages. Isn't that real?
Right, explain it real quick.
The Fed,
because everybody assumes it's like a straight line.
The Federal Reserve lends money to banks, and it goes back and forth because banks don't always carry $1 million in cash at the bank. Sometimes they need a little bit more to cover things. Sometimes they need a little bit less. So they trade back and forth. They're constantly borrowing against each other. So the Federal Reserve cut the rate that they're lending the money to the banks in the United States. That's all that Fed bank cut is. But it's in the language that the bank is telling us that dictates where 30-year fixed rates and, more importantly, 10-year treasuries are going. When they come out and say, hey, we're concerned about inflation is going up, rates are going to go up. When they say inflation looks like it's under control, they're going to go down, right? So what they came out with in the last couple of weeks before the Fed cuts was, hey, it looks like inflation is under control, unemployment is going up. The federal government, unfortunately, had the furlough. That's having a significant impact. And there we see ourselves going into a recession. We go into a recession, there's going to need to stimulate interest rates, and we think that interest rates will drop. That's a great classic move. Typically, that means that interest rates go down a few weeks before the Federal Reserve actually cuts the rates in anticipation of the language. In this case, the language wasn't as good. What happened was every Federal Reserve governor, except for two, right, decided. One said we didn't need a cut. We're looking at inflation and the numbers don't look good. The other one said, hey, we should have cut 0.5%. Well, the one that said inflation was a scary move caused a little bit of a run on the treasuries and on mortgage-backed securities. So that in turn, wackiest thing was you got the rate cut and interest rates actually went up. So everybody thinks they go hand in hand. Not so much. Just the opposite.
All right. Can I try a crack at this?
Yeah. Go ahead. Let's try some crack. What you got?
So the way I try to explain this is people that have a ton of money, like billions, what are they called?
Billions.
What are those types of institutional investors, right? Somebody who's running a hedge fund or managing a portfolio, mutual fund, whatever. Correct. They have decisions to make around where they want to put their money. And when you have that much money, you can't buy a couple houses. You're talking about billions of dollars. You got to make huge, investments. You got the stock market. You have, you can fill in here, Tim. You can buy U.S. Treasuries. You can buy mortgage-backed securities.
The biggest driver is the 2-year, 3-year, 5-year, and 10-year Treasuries. They're the big movers, if you will, on the money.
Yeah. So back to my point, you're talking about long-term investing here. This is not like day trading. We're talking about going to invest this money for 10 years. Because of inflation, we have to make money on our money. Otherwise, we're losing money. So the safest bet is the U.S. Treasury, right?
Yep, exactly right. So because it's backed by the federal government, it will never go bad. And treasuries are typically tax exempt.
So in that decision-making process, another option is to put money into mortgage-backed securities. And you have to get a return on your investment. So what they're looking at is how much money am I going to make on mortgages over 10 years versus the U.S. Treasury over 10 years. So fill in the blanks, Tim. Help me understand. So I'm looking to invest $10 billion, whatever it is, and I'm looking at mortgages, and then I'm looking at U.S. Treasuries. So the Fed drops the rate on U.S. Treasuries, meaning my return on investment goes down a little bit. Is that correct?
Yeah, but it's tiny. Like right now, I'm looking at the numbers. The current 10-year Treasury has a yield of 4.0969. See how far it goes out?
Yeah.
And that's the interest rate, a little over 4%. But it's not really 4 when you realize that we're not going to pay any federal income taxes. So the equivalent
hold on, man.
yield
Work
is like
within my analogy. Like, I'm trying to invest $10 billion.
Sure.
I'm looking at U.S. Treasuries. The Fed just dropped the rate, so therefore, therefore, my return on investment just went down slightly. Is that correct?
That is correct. Yes, sir.
So the Fed rate is directly tied to the U.S. Treasury, or no?
Not 100%. They're just mutual trading partners.
Okay,
that's how I would look at it. Yes, sir.
All right. So another option is to put money into mortgage-backed securities.
Right.
So mortgages have to make enough interest on the mortgages and write good enough mortgages that it's a solid investment to make that potential investment in mortgage-backed securities attractive to a $10 billion investor.
Correct. That's exactly right. You nailed it.
The risk is a little higher than the federal trade. So the Treasury. So you would have to make more money because the risk is a little bit higher, but it does kind of follow because those are the same types of investments those types of investors are buying. Is that why? And is that a correct analysis on why the interest rates are tied to the 10-year Treasury note?
That, and the Federal Reserve also came out and said, hey, we're going to buy a certain amount of treasuries, or we're not going to buy a certain amount, which means then less purchases by the Federal Reserve. We have to rely on the public, that is, to buy federal debt. And if the public gets saturated, they're like, I don't have enough of this. I don't want any more of this. Then what happens in a nutshell is they come back and say, hey, we have enough of it on our plate. We don't want any more. If you want us to buy more, we want a higher interest rate on the product. And that's what causes the big move. That's it right there.
So it's complicated.
Yeah.
It's not a direct line between the Fed.
Not at all. Rate. And that's what people need to understand, that when they think that, hey, Fed's cut the rates. Yeah, they did. But they cut the 30-year treasuries. They did not cut the mortgage-backed securities. That's the difference.
And they can't cut mortgage-backed securities. That's an investment tool.
Mortgage-backed securities are not a direct related product owned by the federal bank. Now, keep in mind, they are federally backed. Like USDA is backed by USDA, HUD, FHA loans, VA loans, of course. And in a certain degree, Fannie and Freddie are backed by the Department of Veteran Affairs, not Veteran Affairs, by the government, because this is the crazy part. They own Fannie and Freddie. They bought them in and they saved them from going under during the Great Recession. Yeah.
All right. So the moral of the story is, if the Fed drops the interest rate, it doesn't necessarily mean a drop in the mortgage interest rate. However, if the Fed consistently drops the interest rate or indicates that it's going to continue to drop the interest rate, should be some sort of a correlation in the long term. Like if the Fed dropped the rate every meeting for the next 5 meetings, it's common sense to think that mortgage interest rates will go down. Is that correct?
They should follow. What you really want to track, Brian, what you want to track is inflation, number one, CPI, and then number two, the other ones you want to track is unemployment. If unemployment goes up, whoa, dude, interest rates will go down. Okay, because it's a sign of a recession. As we get deeper into recession, the Federal Reserve knows that it has to stimulate the marketplace. If the inflation, now here's the kicker, tariffs, right, play any part in the cost of things going up, that means inflation goes up, that means interest rates go up. Now, what's kind of cool was announced in the paper, remember the other day, was the U.S. and China are reaching some agreement that they may not necessarily have to raise and put on 100% tariff. That's huge.
That's
right.
Exciting.
No, it really is huge.
Yeah, everything.
And if that occurs, that means that inflation is going to be more
Chinese stuff. You can't get any more Temu stuff. You can't get any more Amazon stuff.
Look at the shoes that you wear. There's little flip-flops with the 7-Eleven things
like
on
Walmart
them,
goes out of business. Target goes out of business. Amazon goes out of business. I mean, the world comes to a screeching halt.
Exactly.
I mean, America.
And so that's what we don't want. We don't want that to happen. So So we are
All
in
right.
bed, yes, with
So
the
let's shift
Chinese.
gears.
Yeah.
All right, let's shift gears. And you wanted to talk about
Sale
what
prices.
it would
What
take. And
sellers doing right now?
You're a mortgage lender. When you have some insight. Tim, can you just maybe silence that little
I know, dude, it's
dinging
going
thing on your
on. I'm like,
phone?
what the hell's going on, man? Everybody says, oh, you're on the phone with
I know
Brian.
everybody's
Now's
fired
the
up right
time.
now. Everybody
Dude,
wants
they're
to go ahead
hearing
and
this
get a
call.
loan before
Yeah.
rates continue to go up.
Okay, I just turned off at 0. Hopefully it doesn't pop. Yeah. I don't
All
even
right.
recognize it anymore. It's the worst part.
You're a mortgage lender.
Yeah.
You're a mortgage lender, and you have some unique insight that you'd like to share with everyone on what home sellers need to do to sell their property. And I'll chime in as I see fit. What's your thesis or
Brian,
your
what's the number one?
hypothesis, Tim? What is it?
What's the number one mistake that sellers do to sell their home when it's been sitting on the market? What's the number one mistake?
I would say the biggest mistake is do nothing. So I tell people
Okay,
that
that
you
would be
have
number
3
one.
options.
Yep. What's number 2?
All right. So let me just explain. You got
Okay.
3 things you can control as a home seller. You got time, the perceived value of the house, and the actual sales price. Those are the only
Correct.
3 things you can control. You can wait till you find the one guy or gal who's willing to pay what no one else was obviously willing to pay up until this point, or you can improve the perceived value of the house by investing back in the house, or you can lower the price to make it so that it becomes attractive. Those are the 3 things. And then there's, some other things you can do with if you think the marketing looks terrible or you got bad photos, you can obviously adjust the marketing, and you can also do some buyer incentive type things that might not be necessarily the price. So what's your advice, Tim?
So Brian, here's my number one mistake. Ready? When a seller drops the price, all they're doing is making their house look like it should be discounted even more. They look at it, it's going down in price. Sellers are motivated. They're desperate. They got to sell the house. We're going to offer even less on the sale of the house. That's my humble opinion.
Theoretically, it depends. I would say perception is
huge.
To some extent, that's true. It depends. Everybody has a different sort of opinion on that. I would say to some extent, you're trying to come in line with what somebody sees as the best value on the market. And if you're out of line with that, you have to adjust downward to get in line with the best value on the market. Because people look at all the houses on the market, they pick the best one and they buy it. Right. They don't do the super analysis or anything like that.
And why do they drop the rate, Brian? That's why do they want to drop the price? Right. Why?
Well, because you only have, like I said, you only have so many things you can control. You can control the perceived value of the house, and people do not believe that putting money into a house to increase the perceived value is the juice. They don't believe the juice is worth the squeeze most of the time, or they don't want to. There's an aggravation factor in it, or they've not been told to, or they don't know what to do. So the other option is you wait until you find the right buyer who's willing to pay what no one else is willing to pay. But at some point it becomes obvious when other houses are selling and nobody's coming to look at yours, or they keep coming to look at it and not buying it, that you have to do one of the other 2 things, which is either improve the perceived value of the house or lower the price of the house in order to reach the price point in which somebody thinks it's worth buying. That's it. It's not complicated.
So I'm gonna take what you just said and twist it a little bit. Right?
Let's twist it, Tim.
I would never drop my price. Instead, just kind of play with me here for a second. You ready?
All right. Let's work on the premise before you say that. Let's assume that we have a reasonable price to begin with, because
$500,000 reasonable price. That's how I'm going to assume a basis.
Let's assume that the house is actually, let's say the house that you're selling is actually worth what, because you could theoretically have overpriced your house too.
I agree. I totally agree. But let's
say we got an appraisal, and let's say we looked at the market and realistically it's worth 500. Okay, go ahead.
Perfect. Now here's what I'm going to propose to you. You can reduce the price by 15 grand, 3%, go 485. And what that does is that's going to basically in a payment scenario. Oh shit! Sorry, Brian. I swear I turned it down, man.
No, you turned down the dinging. The ringer's still on. You're good.
Oh, you're right, man. I want to hear it. Let me just they turn what they do in a nutshell.
It's like church, Tim. When we go on a podcast, it's like church. Just we got to silence all your devices,
put it in the drawer,
and you don't want to be you don't want to be that guy. You know what I mean?
I don't take my phone in church to be quite honest
Well,
with you.
maybe
Okay.
we need to set a new rule for the podcast, Tim.
Don't take your phone to church. I'm there, brother. I'm there.
All right.
Okay.
go.
So here's the deal. I want you to think about this. If you were to take a $500,000 house and drop the price 3%, which is 15 grand to 485,
Yeah.
you in essence are dropping the mortgage payment by $90.
Yeah.
That's it.
Yeah.
Which means
no, I talk
how
about
many
this
more
all the
people are going
time.
to be able to suddenly afford your house for $90 more? That doesn't work.
There's a couple different ways you can say that. That's one way to say it. Another way to say it is, do you think that your house was overpriced, not worth it, and then $15,000 later it becomes like it's exciting now? Like I saw it at 500. I thought it was overpriced. I didn't really like it. They're like, no, 485, and you're like, oh, I love it. I want to buy it. That's too close to make it
Right. So
to
what if you said, I can offer your house at a 5.25 fixed rate 30-year mortgage today?
For how long?
30 years.
Yeah, no, now it's like a steal of a
And
deal,
now
because do the math on
difference
that.
is right. I just
Go ahead.
did. Ready? You save $90 by dropping the payment here. You save $320 by keeping the rate, by getting the
I like
5.25.
$320, Tim. Let's go.
So that's my point. That's where people make the mistake. It's in the marketing of the house.
Well, not everybody knows about this, Tim. So why don't you tell everybody?
So there's a program out there called Rate Relief, where you can actually pre-buy an interest rate. It's what the builders are doing. Did you ever notice, how is that builder offering 4.99? They're doing a rate relief model, which means they're just buying the rate down ahead of time. It's part of the closing assistance ahead of time. A seller can actually set this up, and typically the fee's like $1,250, Brian. That's it. You're committing to paying 3% in closing, but if you're committed to dropping the price to 3% to 485, or take 500 minus 3%, which is still 485, it's the same thing to the net to the seller. But here, you're going to drive so many more clients because you've dropped the rate, you've dropped the qualifying payment, you've dropped the perception of the home. Now it's like an assumption.
Listen, if I had known about this sounds like a new product, because we've always had a, what do they call it, a 210 buy down.
This is not a 2-1 buy down. This is
2-1 buy down. Sorry,
exactly.
But hold on, let me just say this: like everybody's heard of a 2-1. Not everybody. Most people have heard of a 2-1 buy down. It's the same thing. You buy the rate down for 2 years, and from what I remember, it's not quite $15,000, but it's probably what, 5,000.
It's about 3%. It's the cost
to do
is
a
3%.
2-1 buy downs 3%.
Yeah.
And you're saying with this program, it's also 3%, but you're buying the rate down for 30 years instead of 2 years.
30 years. Remember, a 2-1 buy down, if you started at a rate of 6.25, a 2-1 buy down says first year is going to go to 4.25, second year is 5.25, third year is 6.25 for the remaining 30 years. Yeah. But on a rate relief program where you're going to offer that fixed below market rate today, it is a 30-year rate. Now it's based on, they got to have X scores. They're doing some.
What kind of program is this? What is this? Conventional?
FHA, VA, and
USDA, conventional,
and USDA. I don't talk about USDA right now because the feds are closed. USDA is closed, right? So we really don't promote that as much today.
So help me understand. Is this a Annie Mac mortgage product? Is this a federal
It is
product?
a product it is a product that Annie Mac offers. But I mean, any lender can do it if they had a system to do it. We just do it because we want to help our sellers sell their homes. We want to help the listing agents get the house moving. And it's what the market needs today.
All right, so let's back up. So you're saying that for 3%, you can buy the rate down what is essentially 1 full percent of today's interest rate. So let's assume today's interest rate is what, 6.25?
6.25. You're buying it down using an FHA loan or VA loan
to 5.25.
Yeah.
To 5.25.
Yeah. And you can advertise that in your listing. Now, here's the cool part. You ready? When we set this up, the seller signs an agreement. Okay. And there's my I swear, I put it in the drawer.
You're struggling today, Tim. You're struggling.
I'm struggling. You're struggling. But look, here's the deal. The seller signs an agreement, says, yes, I will pay 3% in closing help. The total cost to the seller is $1,250. That's it. And if they use Annie Mac for the
I
mortgage,
thought you
they
said
get
it was
back.
$15,000.
It's 3% in closing assistance to buy that rate but we don't collect it up front, Brian. So when you're advertising, you're saying, yeah, you can get a 5.25% rate FHA or VA. But let's say they're like, hey, you know what? I don't want to use those programs. I want to go with a Maryland mortgage program. You say, no problem. Instead of buying the rate, we're going to give you that 3%. And you can use that for down payment assistance, closing costs, whatever the case may be.
But you just said it's $1,200. Like, who pays the 3%?
The seller pays the $1,250 up front.
Mm-hmm. Up front,
up front. Yeah, just when we go
like right
because
now.
we're guaranteeing the rate.
Interesting.
This is how we can guarantee a 5.25% rate today for the next 60 to 90 days.
So 60 to 90 days, and then what happens then to 60? You pay another $1,200.
No, you get an extension. We extend it for 30 days. In most cases, we'll extend it for free. Depends upon the market. Now, I want you to hear about this, Brian. Ready for this? So you sign up for this program. You're a seller.
Did you have this program 90 days ago? Because I just put 3 houses under contract, Tim.
I did not.
Okay. All right.
Yeah. But I want you to think about this. Ready? $1,250 is the fee.
Yeah.
They pay the fee.
Mm-hmm.
They do the loan with Annie Mac. Annie Mac says, you know what? Here's your money back, my friend, because you used Annie Mac. Okay. So they get the $1,250 back, and it's part of the 3%. There you go.
Part of the 3%. Who pays the 3%? The seller at closing?
The seller's going to pay the buyer at closing.
The buyer could pay it too, right?
Buyer can pay whatever, but in this case, we've set it up so that the seller pays 3%. Yes, sir.
I got you. So the seller pays 3% at closing. They upfront $1,250. They get that $1,250 back. Then they pay back 3%. And they lock the buyer in, and the buyer has to use Annie Mac Mortgage, but they can use any of
they can use anybody they want. They just won't get the $1,250 credited. That's all. They can go to John Hanson Mortgage, whatever. They can go to Brian Mayer Mortgage. The $1,250 is just not credited back because we've actually bought a future, and that's what it costs to buy the future, $1,250.
So is this a federal program?
No. This is an Annie Mac program. This is an Annie Mac program designed to be used for FHA, VA, USDA, and conventional financing.
Interesting.
So here you are. You're a listing agent, and you're like, you know, Bob, Mary, your house hasn't sold in the last 90 days, and we got to do something. We should drop the price $25,000. No. Offer a rate relief first.
I would do the rate relief on the first day we put the house on the market.
Every day. That's exactly right. I mean, imagine how. Now, what have you done? You've changed the perception, right? Okay, we're not dropping the price because there's something wrong with the house or the house isn't worth it or overpriced. You know what we're doing in nutshells? We're stimulating the market. Imagine the number of buyers that will come out of the woodwork because you gave them a 5.25% rate. I'm just being honest with you.
No, I agree. It's essentially like an assumable mortgage scenario. I have a settlement an hour and 31 minutes ago, and we were able to sell the property exclusively because we had an assumable mortgage at 2.75%. We sold it at a huge number because of that. And prior to us using, because they didn't want to do it at first because the sellers were aware it was going to drag this thing out for another 60 days at settlement, which it did. And the lender was horrible, which they always are. But
assumptions are a pain. But Brian, 2.75?
So that when we started advertising the 2.75 it was like your phone, Tim, started ringing and ringing, and I was getting text messages and people coming. And then we ended up with multiple offers. Everybody who was interested with the same question. What's up with the assumable mortgage? Do you have
there
to
you go, man.
VA?
Exactly right. There you got it. Exactly right.
All right. Yep. That's crazy. That I wish I had this 90 days ago, because I mean I literally could have sold
but now you have it today.
I would have done this with every single one. Yeah. All right, Tim. So last thing I want to go over real quick. What's up with the market? How are things actually right now?
You want me to give you the positive spin or the truth?
Let's do both. Let's start with the positive.
Man, the market is awesome. Do you know why the market's awesome? It's really simple, okay? Because houses are on sale, Brian. Sellers are paying closing help. Sellers are repairing homes. Sellers are motivated to make the deal work. So, in my opinion, it's the best time to buy. I also recognize that when interest rates go down, sale prices go up, which means you're getting a house at a discount today because in the next 12 to 18 months, when the rates are in the low 5s, high 4s, what's going to happen to the price of the houses,
Maybe, Tim, maybe.
and you're going to be able to refinance. Now, on the other side of the coin, go ahead. What's wrong with the marketplace today?
Yeah, I was going to say, give me the truth.
That was the truth.
You said you want me to give you the good side or the truth?
The truth is, actually, it's a great time to buy.
It is a great time to buy, but what's going on in the market? Like number of sales.
It's a little harder to sell. Well, what's happening in a nutshell is there are fewer buyers in today's marketplace because of uncertainty in the economic times, i.e. the Fed funds, the Fed furlough is having some impact now on not just federal employees, but it's starting to layer down. It's not only is the federal employee, but now it's the defense contractor, which is not only the defense contractor, but it's a car sale person because he can't sell enough cars now, which is not only the car sales guy, but it's the grocery store people because they don't have enough money to be people buying groceries. It's not only the grocery people, but now the one group that's doing well is the liquor stores. Because typically in bad times, liquor sales go up. So
I did not know that.
So, the things you learn, Brian. What can I tell you, man?
Yeah, these podcasts are helpful for me, Tim. Thank you.
Oh, man, you know it. So at the end of the day, Brian, what do I see? Honestly, it's a good time to buy, my friend. And with that said, that's all I got.
Well, I appreciate you, Tim. Thank you.
Always.
Very insightful. I'm going to advertise. Do you have a flyer you can send me on this mortgage thing?
Let's put something together on me. I love to do that. Yeah, we'll figure something out for you, man.
I'm going to clip this up into a video, and then I'm going to put it out on some socials because this is a big deal, to be honest with you.
It's huge. All right, my friend. Seize the day.
Happy Halloween, Tim.
Yeah. Happy end of October there, Brian. Good to see you, man.